Welcome back to the Old Fashioned Real Estate Show. I'm Brian Leverage, and he's Jeffrey Holst.
That's correct.
Cat got his tongue, which is very rare these days.
Today's episode, we are actually going to do a market recap for 2023, kind of where we are at the end of the first quarter in 2023 and what we think is going to happen and what kind of investments we're making right now. So stick around.
Right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
All right, so we're filming this episode at the end of March 2023. So if you're watching this at some point in the future, we can only talk
Then it
to
will
what's
have been the past.
Yes, we can only talk about what we know today. We can't talk about stuff that happened after today. So for example, if a new pandemic comes tomorrow, we don't know about it yet. Okay, yeah. But that is actually,
But since we'll get accused of BSing people, let's just say we're sorry now.
Yeah, so we apologize in advance for missing that prediction. So we have a long history on our show of talking about where we think the market is going. And we've made some predictions, starting already back on one of our earliest episodes where I outlined why I didn't think there would be a crash in the real estate market until sometime around 2024. So far, that has proven correct. We have not had a crash. But there's a lot of people predicting a crash right now. A lot of people are talking about how the market is slowing with interest rates rising. And, as we sit here now, interest rates have gone up faster in the last year than almost
40.
Yeah, than almost anyone could have predicted, right?
Yeah.
I mean, we were all talking about how interest rates were going to go up a year ago, but I thought they would go up 1 or 2 points. I didn't think they would, didn't think they were going to go up 2.5 times.
Yes.
So that's caused some uncertainty in the market, and we're definitely in an uncertain point.
Yeah, we're seeing some headwinds. I think, it's important to remember too that, real estate is a lagging economic indicator, right? So there are other economic indicators that I don't follow personally, not because of it, it's just, how it is. But as it sits right now, the market appears to be cautious, but optimistic.
Yeah, I think that's right. So there's a couple of competing issues, right? You definitely have rising interest rates, which is a drag on the overall real estate market, but they're doing that in response to unprecedented inflation. Just a quick summary of how that works. If they're loaning money below the rate of inflation, which is what they had been doing for a year or so before they started raising rates, it hyperinflates the market. It causes people to be wanting to borrow as much money as they possibly can, which drives up prices, which drives up more inflation. So the idea generally is if you raise interest rates above the rate of inflation, it will slow down borrowing and people will be less likely to borrow money, which will slow down the economy and will cause things not to go up as fast and potentially even create a recession. Most people don't like to admit that, but that really is the Federal Reserve's goal in a situation like this, is to create a quick, soft recession, right?
Right. Well, they also, the Fed, there's a couple things they can do in the event of a recession, right? Bond buying is one to kind of artificially keep prices down.
Right.
And then they also set, the overnight rate on funds as well. So they've been raising the prime rate obviously quite a few times in the last year, 15 months or whatever.
There's some evidence that it's working too. So inflation has gone down eight months in a row going into this month. Now, it's still 6%. But
part of the reason for them to also go up, in addition to what you say, is we will inevitably end up in a recession at some point. I think that much is clear. And it gives the Fed the ability to then in the future actually reduce those rates again.
Yeah, because lowering rates is how you
if
stimulate
you're near
the
zero
economy.
already, you don't have you lose one of your bullets, so to speak.
Yeah, so lowering rates is one of the ways that they stimulate the economy. So and that's what I'm saying. Like right now we're facing nearly unprecedented, not completely, because in the late 70s, early 80s, we saw a very similar thing, and it did cause a recession that lasted about 18 months. And at the end of that recession, the economy started to recover. They started lowering rates again in the early 80s. And they continued to lower rates essentially until 6 months ago. 8 months ago, right? I mean, they had lowered rate. I mean, occasionally you'd see a little uptick, but it was definite downward trend from like 1982 to 2022. And so it is a weird place to be in the market. But I don't believe that that means you should stop investing. Brian and I continue to invest. In fact, we're about to close on a 56-unit building now, so we should do that next week. We've bought an office building this year. I think you just put some other land under contract to do some building.
Yes, I continue to build houses here locally and flip a few houses as well. In fact, I think we've got we also have an apartment building, small one under contract to sell that should close I think in the next 30 days and the same with the package of duplexes we had bought a little more than a year ago to fix up, take the rents to market, and then sell, which we're executing on that as well. So it's interesting because from a single family housing standpoint, and I'm just talking about locally here, okay, it's going to be different in your market based on a whole host of factors. But what we're kind of seeing is there's still a lot of activity at 400,000 and below, right? There's still plenty of buyers. As much as rates have come up, incomes have also jumped a lot, right? So that has kind of helped offset the reduction in purchase power through borrowing.
And people who were buying $500,000 houses are buying $450,000
or whatever.
And I think we see that on our two condo developments. I feel like sales have actually upticked in the last 6 months on some properties that we had. We were essentially converting apartment buildings into a condo regime and selling them off individually.
I do, on more of a national level, see a lot of industrial properties they're just being marketed by national brokerages, right? So and this goes from the West Coast all the way to the East Coast and everywhere in between. And so it's fascinating to me because since last summer, I've noticed that these industrial properties they'd come out at one price. They don't get a lot of traffic, and now they're retrading, being listed or reduced in price to make them more attractive to potential buyers.
Yeah.
What I haven't seen that happen on is apartments.
Yeah, no, I haven't either. Although I will say, apartment transaction volume is way down.
Yeah.
So, and we see this in our own case, right? Like things that we thought about selling, we're just kind of like, well, we're just not going to sell it right now because it might not sell for as much as we want. And if you bought anything more than a year ago, you're probably in it at a good price because the values had gone up for a very long time, rents had gone up for a very long time, and so I think that the real thing that we're seeing, where people are saying prices are going down, even in the industrial stuff, it's actually not that prices are going down. It's that people were marketing stuff at higher and higher prices because things have been going up so fast that people just kept throwing out higher and higher numbers. So we see that here locally. The average sale price has gone down, but that does not necessarily mean that values have gone down. Certainly they're not going up like they were a year ago, right? I mean, when I sold my primary residence last year at around this time, I mean, it sold near instantly, right? I mean, it was on the market for 48 hours, and we had several offers. That's not true today. So there's definitely a slowing in the market, but that's different than a crash. It might be it might be foreshadowing a crash, though. It is possible that we could see somewhere downward reduction in prices.
And we're still seeing, inventory, while it is up, is still at a, compared to historical averages, low overall number.
There's a shortage of housing units nationwide, as far as I can tell. There are probably some markets where that's not true, but it certainly is true here in Chattanooga that there are way less available inventory than what we actually need for a healthy market. Part of that is because people with low interest rates are choosing not to sell. If you have a 3.5% rate on your mortgage and you're looking to move, you go, if I buy a similar priced house, my mortgage is going to be double as expensive. You kind of second guess whether you actually want to sell or not. And that's actually an interesting result of the rapid increase in interest rates. It's not something that we've really experienced before.
Yeah.
I do think that now it's more important than ever because of the uncertainty in the market to get back to fundamentals. I've said for years, buy whenever you buy and sell when it's high. That's how you time the market. But I believe right now, if there's some property that's giving you trouble, if you think it's going to be difficult to maintain rents or something like that, this would be a great time to sell because stuff is still selling at pretty high prices. But if you're going to be looking at buying something, right now you need to be very conservative in your underwriting. You need to be very certain of your numbers and make sure you're really, really focusing on those fundamentals. Because if you're wrong, what you don't want to do is be stuck underwater with a property that's not cash flowing in the middle of a recession.
Yeah, it's one thing to buy something that's got a negative carry to it out of the gate because, say, the rents are really low or the expenses might be really high or a combination thereof, right? Like, we do a lot of those types of deals. But we also know what's going to happen on the back end.
Right.
So if you have the uncertainty about that, then you probably shouldn't be doing it.
Yeah, and this doesn't mean that we can't still buy a property that has a negative carry. We can do that because we know, like, if I buy a property that's next door to another property I have, I'm pretty certain what the rents are going to be. Mm-hmm. If my rents with a fixed up unit is $1,000 and I'm buying a property that's renting for $500, it's pretty clear that if I fix it up, I'm going to get close to $1,000. And so you can do that still, but you need to be more certain than before, because before the market was bailing people out, and there's a lot of investors that benefited from that, and us included, obviously. And some of those investors think that they know exactly what they're doing, and it may be that they don't. And I'm not pointing fingers at anyone. I hope that I know what I'm doing. That's why I continue to try to educate myself about the markets. And I really think you mitigate that risk by spending a lot of time getting that deep market knowledge. I mean, it's kind of what we were talking about in our episode a few weeks ago where we talked about investing out of state. It's important to, especially now, to really have that deep knowledge of the market that you're investing in.
And, staying well capitalized.
Yeah.
Beyond what you think, just as a buffer, right?
Yeah. I mean, I would. So the thing about real estate is, if you bought in 2006 and you had to sell or refinance in 2010, you got screwed. But if you bought in 2006 and you had to sell or refinance last year, you did really, really well in almost every market in the country. So my thought is, right now, if you're buying, it may be we're at a peak in the market. We may not be. It's impossible to know for sure. But if we are at a peak in the market, you don't want to be in a situation where you're buying something that you're going to be forced to sell or refinance 2 years from now or 3 years from now, because we might be in a recession then and values may be down and you may just not have an option for that. So you're going to want right now to have adequate cash reserves, like you said, well capitalized, long-term debt. Like, this is not the time to be doing bridge lending unless you have a very, very clear plan of what you're doing with that property. And even then, I'd be really skeptical of that. I'd say you want some long-term debt, non-callable long-term debt, and probably fixed rate debt as well. I don't think you want variable rates, because we don't know that rates aren't going to keep going up. Mm-hmm. They probably won't, but we don't know that, right? So, and you can always refinance if they go down. You don't get the option of refinancing if your rates go up, unfortunately. So you definitely want to watch for that. So, and you want to make sure you have adequate cash flow, because cash flow is really the biggest safety measure. If your property cash flows, it pretty much solves all other problems. Yeah. So if you can have good cash flow, adequate cash reserve to cover emergencies and contingencies, and then also long-term fixed rate debt, I think it's fine to buy right now. But if you can't meet those requirements, you need to be really careful. Mm-hmm. Oh, of course, if you're buying for cash, that's even, then you don't have to worry about the debt issue as much.
Your risk goes
much
way
less
down.
risk. And you know what? That's when your cash flow goes way up, which is why your risk went way down. The more cash flow, the safer the deal. So in a lot of ways, that continues to be the
and right
case.
now, because of where rates are at, I mean, if your cap rate doesn't exceed your loan constant by 1.5 to 2 points, like, you're better off paying all
Yeah,
cash.
I mean, honestly, like, if they're loaning money to you at 7% and you're buying at 6% cap rates, the more you borrow, the less good the deal is. Mm-hmm. And that's called negative leverage. It's something that it's not been the case for a long time, but it is the case now in a lot of deals. Well, anyway, that's where that cheery note. That's where the market sits today. My advice to you would be, keep buying good deals.
Marry the asset, date the debt.
Yeah, but keep buying good deals. That's still my advice. And Brian, anything else you want to say?
No, we covered it.
All right, that's the show.